Welcome to the Three Edge Week in Review for the week of April 26, 2021. I'm Fritz Folts, Chief Investment Strategist here at Three Edge, and today I'm joined by a special guest that I believe you will recognize, Eric Biegeleisen. Eric's the Director of Investment Research as well as the Deputy Chief Investment Officer here at Three Edge Asset Management. And today, along with a brief update of the global capital markets, Eric and I will be providing a glimpse into our Three Edge proprietary research model, and we'll be discussing Fed policy on something that we refer to as the shadow interest rate. But first, a very brief market update. It was an up and down week for Wall Street, with stocks dropping from all-time highs and then closing on a down note on Friday. This was in spite of data that continues to show a robust economic rebound in the U.S. as the country emerges from the global pandemic. A report on Thursday showed that U.S. gross domestic product expanded at an annualized rate of 6.4% in the first quarter, driven by the second fastest pace of personal consumption since the 1960s. In inflation news, the Personal Consumption Expenditure Price Index rose 2.3% in March from a year earlier. That's the biggest gain since 2018. In addition, the Core PCE Price Index, which excludes food and energy, climbed by 1.8% in March after an increase of 1.4% in February. And this core PCE index is important to keep an eye on since it is the gauge that the Federal Reserve uses for its inflation target. Meanwhile, speaking after the latest Federal Open Market Committee meetings on Wednesday, Fed Chair Powell noted that 12-month measures of inflation are likely to move, quote, well above the Fed's 2% target over the next few months. But Powell claimed that the effects will disappear in the months after May. In company news, the price of Amazon stock reached a new record after the company reported quarterly earnings for the first quarter of 2021 that exceeded analyst projections. Amazon also provided a second quarter sales forecast that was much stronger than expected. And now, after a strong 4 months of equity market performance, don't be surprised if you begin to hear the familiar Wall Street refrain of sell in May and go away, as investors will now debate whether or not the strong reflation of the U.S. economy is or is not already reflected in stock prices. So now let's bring Eric into our conversation. So at Three Edge, we are a model-driven investment firm, but our approach should not be considered to be simply a black box. We refer to our approach as human plus machine. And in that regard, today, we're going to take a closer look at an example of how our research and investment team worked with the Three Edge research model to analyze and better understand an important aspect of the extraordinary Federal Reserve monetary policy since the pandemic. And we take a look at something that we refer to as the shadow interest rate. So Eric, maybe to get us started, it's important to remind us just how extraordinary the degree of monetary policy intervention we have seen from the Fed has been over the past year in response to the dramatic economic downturn brought on by the onset of the global pandemic.
Yeah, thanks, Fritz. It has been pretty unprecedented. The Fed has many policy tools at their disposal to keep the capital markets functioning as this well-oiled machine, all in support of their dual mandate of price stability and full employment. And for a long time, they largely used these three main tools. First off, before we get to the tools even, they're there to set a policy rate, the price of money, really. And then they use these three tools. That is open market operations, which is the purchase and sale of securities on the market. They utilize a discount window and a discount rate, and that supports liquidity and stability of the banking system. And then reserve requirements on how much, determining how much banks capital they have to hold, which as of March 2020, they actually lowered to zero. But as you can see on this slide here, there's a number of policy tools beyond those three, and there's a whole number of facilities, credit facilities that were targeted towards very specific market subsets. Again, on the attempt to keep credit flowing smoothly to help a variety of businesses and organizations. Now, most of these facilities have largely sunset as of December of 2020. Some did sunset even earlier this year. Those are going to still be things that sit on the Fed's balance sheet, but they're no longer open programs. Another policy tool that's not listed here is the influence on market perceptions. That is when new data comes in and market participants anticipate how the Fed's going to react to that, and or the actual words spoken by key Fed policy decision makers, most notably the chairperson of the Fed. And then finally, also not listed in that list was quantitative easing, which is an emergency tool the Fed has been using in a huge way to expand their balance sheet.
So Eric, that is a mighty long list of Fed policy responses. And as we know, Steve has often spoken about what we refer to as the Federal Reserve's magic money tree, which is a way to think about, in Fed speak, quantitative easing, or QE, and the commensurate expansion of the balance sheet. So maybe you could describe that in a bit more detail.
Yeah, absolutely. You guys have noted this unprecedented monetary stimulus and this magic money tree concept for some time. This concept of quantitative easing is the Fed really increasing the supply of money by purchasing longer-term treasury bonds and mortgage-backed securities. They just reconfirmed that at their last meeting to the tune of about $120 billion per month. That'll ultimately end up being about $1.5 trillion of purchases in 2021. And as a reminder, that's on top of the 3.3 trillion they did last year in 2020. So you can see on the chart here that the run rate pre-financial crisis of 2008, that there was a small predictable growth rate in the balance sheet. Then following the global financial crisis, you see that it's clear that on multiple occasions the Fed attempted to taper or reduce their holdings, only to have to stimulate even more during the next market hiccup. So this is a concerning cycle for sure.
Well, I mean, that is an astounding chart in and of itself, but also it's critical is to understand the effects of pursuing such a major expansion of the balance sheet in terms of nominal levels of interest rates. And not only that, but I think what we're going to get to here is sort of this unseen impact, which we refer to as the shadow rate. So maybe you can dive into that now.
Yeah, so in some ways, our model picks up all of this stimulus through a variety of momentum measures, changes in certain credit spreads that we look at, but not entirely. And so about a year ago, we added some new research into our model that we had been working on for some time from a paper co-authored out of the University of Chicago Booth School, as well as UC San Diego. And using this research, we were able to quantify and map the expansion and contraction, when it happens, of a central bank's balance sheet and its effect on short-term rates to create this so-called shadow rate. And so this allows us to measure the change in short rates and, more importantly, its impact on our yield curve measures for the different market economies that we model. So the chart shown here shows the 3-month T-bill rate, which was brought to the Fed's lower bound of 0% in March of 2020. And that was to combat, of course, the negative effects of the spread of the virus. And they refused to go lower, but they're still stimulating through these new policy tools and the QE. So we need a method as folks trying to model these markets. We need a method to pick up this additional stimulus. Mm-hmm. And as you can see with this orange line now, we've quantified these effects into their impact on short-term rates. So currently, the world sees the T-bill rate at just above 0%. While our model would perceive the short rate to be around negative 1.29%. So that's quite a difference. Now, it's also worth noting that this model includes a decay factor as well. So if the Fed were to just stop all purchases and just maintain this same level on their balance sheet, then the shadow rate would eventually drift back and converge to the prevailing market rate. So this helps us quantify the stimulative effects of all central banks for the markets we model, not just the US. I just want to make sure that's clear.
Yeah, excellent. Great. So by employing the shadow rate, we see what are effectively negative short-term interest rates, and thereby creating a steeper yield curve. And with all else being equal, that should be positive for the equity markets. And it has been a factor that has kept us invested in equities. However, there are other factors, including valuations in the research model, to consider that have led us to also invest in ex-US equities. So maybe you just bring that into the calculation as well.
Yeah, absolutely. Yeah, it's funny because we talk about this shadow rate and how it's actually more negative than maybe the market shows, and therefore wouldn't that be considered a positive sign, particularly when you're looking at a much steeper yield curve when you have the shadow rate now at the short end. And the answer is, yeah, that is a positive factor. And we do have, generally speaking, a positive outlook on U.S. equities. It's just that, as you noted, our outlook on international equities is so much greater, in large part just due to the overvaluation we are seeing in U.S. equities, which just is more than offsetting some of those positive factors from a factor like this.
Excellent. Great. Well, thanks, Eric. My hope is that we've been able to provide an example of how, in order to account for things that are rather unprecedented in the current environment, for example, Federal Reserve policy in response to the coronavirus pandemic, both the research team and the investment team, as well as the research model, have needed to continue to learn and to evolve, since more traditional and conventional research methods would not have been sufficient to understand all the effects of the policy action. And thank you very much for making that clear for us. So that will do it for us. But Eric and I will be back next week with our monthly view from the edge for June of 2021, where we'll explore our current model outlook for the global capital markets. Remember that all of our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. So on behalf of everyone here at 3Edge, we urge you to remain safe, to stay strong, to keep the faith, and most of all, thanks for listening.